Property investment in Australia offers more than just potential financial growth. It presents a strategic pathway to minimize tax liabilities and enhance your overall wealth-building journey. By understanding and leveraging the various tax benefits available, you can optimize your returns and secure a brighter financial future. This essay will serve as your comprehensive guide to navigating the landscape of property tax minimization in Australia. Investing in property is a significant financial decision. However, it can be highly rewarding, especially when you understand how to use tax laws to your advantage. Australia's tax system provides investors with a range of legitimate strategies to minimize their tax obligations. Throughout this essay, we'll delve into the intricacies of these strategies. We'll provide clear explanations and illustrative examples. This will empower you to make well-informed decisions. Remember, this essay is for informational purposes only. It should not be considered financial advice. It's crucial to consult with qualified tax professionals. They can offer personalized guidance tailored to your unique circumstances. One of the most well-known and widely utilized tax benefits in Australian property investment is negative gearing. This strategy allows you to offset the costs associated with owning and managing a rental property against your other taxable income. In essence, negative gearing occurs when the deductible expenses of your investment property, such as mortgage interest, council rates, insurance premiums, and repairs, exceed the rental income it generates. This results in a net rental loss, which you can then deduct from your other income sources, such as your salary or business income. The beauty of negative gearing lies in its ability to reduce your taxable income. This can lead to lower tax payments and potentially even increase your tax refund. For individuals in higher income brackets, negative gearing can be particularly advantageous, as it effectively reduces their marginal tax rate. However, it's essential to remember that negative gearing should not be the sole driver of your investment decisions. The long-term success of your property investment hinges on factors like capital growth potential, rental yield, and your overall financial strategy. Depreciation is another powerful tool in the property investor's arsenal, allowing you to claim deductions for the wear and tear of your investment property over time. This includes both the building's structure, known as capital works allowance, and its fixtures and fittings, referred to as plant and equipment depreciation. The Australian Taxation Office, or ATO, sets specific depreciation rates for different types of assets. These rates determine the amount you can claim each year. For example, you can depreciate the building's structure over a period of 40 years, while carpets and appliances might have a shorter depreciation period. To accurately calculate your depreciation deductions, it's highly recommended to engage the services of a qualified quantity surveyor. These professionals specialize in assessing the depreciable value of your property's assets, ensuring you maximize your claims within the bounds of the law. By claiming depreciation, you can effectively reduce your taxable income, freeing up more cash flow for other investments or personal expenses. It's a valuable strategy to optimize your returns and enhance the overall profitability of your property investment. When you eventually decide to sell your investment property, capital gains tax, or CGT, comes into play. However, Australia's tax system offers concessions to soften the impact of CGT on your investment profits. One of the most significant concessions is the 50% discount on capital gains for assets held for 12 months or longer. This means that only half of your capital gain is added to your taxable income, potentially leading to significant tax savings. Another valuable concession is the principal place of residence, or PPOR, exemption. This exemption allows you to sell your primary residence free from CGT, provided you've lived in it as your main home. Furthermore, the 6-year rule allows you to rent out your former PPOR for up to 6 years while preserving its CGT exemption, offering flexibility for investors transitioning between properties. Understanding these CGT concessions is crucial for planning your exit strategy and maximizing your after-tax returns. By holding onto your investment property for the qualifying period and leveraging the available exemptions, you can significantly reduce your CGT liability. Owning and managing a rental property comes with a range of expenses, many of which you can claim as tax deductions. These deductions reduce your taxable income, lowering your overall tax burden. Some of the most common deductible expenses include interest on your mortgage. This is often the most significant deductible expense for property investors. Council rates. These annual fees are levied by local councils for services like garbage collection and road maintenance. Water charges. These cover the cost of water usage in your rental property. Insurance premiums, building, contents, and landlord insurance are all tax deductible. Property management fees. If you engage a property manager, their fees are also deductible. Repairs and maintenance expenses incurred in fixing damage or maintaining your property are generally deductible. It's crucial to maintain meticulous records of all your expenses, including receipts, invoices, and bank statements. This ensures you can substantiate your claims if the ATO ever audits you. Remember, only expenses directly related to your rental property are deductible. Personal expenses are not eligible for deductions. Prepaying certain expenses can be a savvy tax minimization strategy, allowing you to claim an immediate deduction for expenses that span multiple financial years. This can be particularly beneficial if you anticipate being in a higher tax bracket in the future. Common examples of prepayable expenses include interest on your mortgage. You can prepay up to 12 months of interest in advance, claiming the deduction in the current financial year. Landlord insurance premiums. Some policies allow you to prepay several years' worth of premiums, giving you a larger deduction up front. However, it's essential to weigh the potential tax benefits against the time value of money. Tying up funds in prepaid expenses might not be the most financially sound strategy if you have other investment opportunities or need the cash flow for other purposes. Consult with your financial advisor to determine the optimal approach for your circumstances. In the past, investors could claim deductions for travel expenses related to their rental properties. However, recent changes to tax legislation have significantly restricted these deductions. Currently, you can only claim travel expenses if you're carrying on a business of renting properties. This generally requires owning multiple rental properties and actively engaging in activities that go beyond passive investment, such as property development or renovation. For most individual investors who own 1 or 2 rental properties, travel expenses are no longer deductible. This includes expenses like inspecting your rental property, traveling to meet with property managers or tenants, attending property investment seminars or conferences. It's crucial to be aware of these restrictions to avoid inadvertently claiming ineligible expenses on your tax return. If you're unsure about the deductibility of specific travel expenses, consult with a qualified tax professional. For those seeking greater control over their retirement savings, self-managed super funds, or SMSFs, offer an attractive avenue. An SMSF is a private superannuation fund that you manage yourself, giving you the flexibility to choose your investments. One key advantage is the potential for tax-effective income and capital growth. Rental income is generally taxed at a concessional rate of 15%. Capital gains are taxed at a maximum of 10% if held for over 12 months. Once you retire and commence a pension phase, income and capital gains are generally tax-free. However, setting up and managing an SMSF comes with significant responsibilities. You'll need to comply with strict reporting obligations. Ensure your fund meets all legal and administrative standards. Seeking professional advice from financial advisors and SMSF specialists is crucial. The property market evolves with government policies, economic conditions, technology, and sustainability trends. Investors must stay updated to adapt their strategies. Key areas to watch include government policies. Changes can impact returns. Market conditions. Interest rates and housing supply affect values. Technology. Innovations like virtual tours and blockchain. Sustainability. Demand for eco-friendly properties. Stay informed to capitalize on opportunities and mitigate risks. Continuous learning is essential for success. Seek professional guidance from qualified experts. They help optimize strategies to achieve financial